Okay, hopefully we're live here. It's Mark Gomes, PTT Research. How you doing? We're going to have a Q&A session tonight focused primarily around the yellow alert that we've issued. We're open to answering other questions for you, of course, for customers. Your Q&A button should enable you to ask questions. You should also be able to vote on questions that you already see that are of interest to you. So hopefully everything's up and running. I'll double check with some of my sources here to make sure that we are live. And I'll start off with a little bit of background on the yellow alert and what it means. So first of all, a yellow alert obviously is not a red alert. It is a precursor to a red alert potentially. And what it basically means is that, quite simply, the potential reward inherent in the market does not look attractive relative to the risk in the market. Now, if you've been a PTT customer for a while and been paying attention to the things that I've been saying, you know that I've been talking about the U.S. gaining strength in its economy at the expense primarily of manufacturing in China and energy, which obviously would hurt Russia. And those were the two countries that I'd been singling out. And sure enough, over the last week and a half, we have seen a dramatic change of fortunes to the negative for the Russian economy as oil prices have plummeted, putting that economy in a little bit of risk and chaos. If you look at the some of the Russian ETFs as hedges, if you were smarter than I, you jumped on those. I had the Chinese ETFs, didn't bother to look for Russian ones, but there is a Russian 3X negative ETF that went from 26 on the day of the yellow alert and went to 65 in just a week. Dramatic move there. It has since pulled back pretty strongly to 32, but still from 26 to 32 is pretty good. And if you caught that ride from 26 to 65 and we're anywhere in the ballpark of closing out that position there, good for you. We've had additional positions here. We'll take a quick look here. Today, of course, the Fed stepped in with a little bit more positive language than was anticipated. That comes as no surprise given what's happened over the last week or so. And so we had a big jump in the stock markets today. But still, relative to when we put out the yellow alert, the S&P 500, as indicated by SPY, the S&P ETF, has gone from 207 to a low of 197 and still sits at 202. So that's down a couple percent. Not bad for 1 week's work, and particularly if you decided to pull a little bit of that hedge off the table after that quick, strong move, which is never a bad move. And it's more art than science, of course. We can never predict exactly when something's going to happen. I had no idea that things were going to unravel with the oil market and Russia at this particular time. There's no way you could predict something like that. However, you could look at the charts of the various markets, understand what's been going on with manufacturing, with oil, seeing the oil prices dropping, seeing those tensions rise, and say, hey, risk has been rising, but stocks have been rising too. So the potential reward for stocks that have reached this level, while risks have also reached this level, it's not a very good situation. And that's where the yellow alerts come from. How does that turn into a red alert? Well, we have to see something more dramatic happen. Okay, today was a good step in the direction of determining how powerful this yellow alert is going to be, namely because of the Fed's language. They're going to be more accommodative. We're going to see how much good this does to ease the markets, both for oil and the economies around the world. And the stock market, of course. One thing I will say is that the currency markets and the bond markets did not respond as aggressively as the stock markets did. That is problematic. The smarter money exists in the bond markets. The bond markets tend to know better. So to see more of a muted reaction out of the bond market and the currency markets is a little disconcerting. We'll see what happens. Of course, you have to realize, and this is very important for those of you who either weren't involved in the stock market in 2000 and 2008 or didn't do so well during those markets. You have to realize that in a weakened economy, you're going to see more accommodation. You're going to see quantitative easing. You're going to see lower interest rates. You're going to see all those things. And when those news stories come up, I remember in particular in 2008, you had these sharp pops in the market, 3, 4, 5% pops. When the government, when the Fed, when whoever came to the rescue of the market, so to speak. But unfortunately, those efforts in such a strongly declining market were inadequate to actually save the market. So those pops turned out to be short-lived, one-step ups, precursor to 2 steps down that would soon to be coming. That's what we're monitoring for right now. If we see something break down to the point where it feels to us like government intervention, Fed intervention is not going to be able to stop the dominoes from falling down, that's when we'll go to a red alert. As of now, we of course have to remain at yellow alert. We got a really nice initial pop that's good for profits, initially at least. But remember, the risks remain very high. There's no all clear. What the Fed said today did not do anything to give us an all clear. Oil prices did not rebound strongly. Unless we see oil get back into like the 80s, you know, we're going to have troubles around some of these countries like Russia, like Venezuela. That can cascade down to other folks. And as you see, like the Apple store was closed down in Russia because they don't want to take on the currency risk. That creates economic problems, not only for Russia, but also for companies like Apple who are not doing business in Russia online right now. So keep that in mind. Of course, lower oil prices is great for the U.S. economy, right? We utilize a great deal of oil, so it's kind of like a tax break. It's especially good for sectors like restaurants, right? If you fill up your tank and you have an extra $20 sitting in your pocket at the end of that visit to the gas station, you might say to yourself, hey, I'm not going to McDonald's today. I'm going to go to Applebee's or the Red Lobster, or maybe I'll go to Ruth Chris, you know, a higher end restaurant, right? You're going to spend your money on nicer food, better beverages, right? And those restaurants, those upgraded restaurants that you go to are not going to spend as much to service you because the oil, the energy that they use to get the ovens rolling, to light the restaurant up and things like that, it's not going to cost as much. So their costs are lower, their revenue's higher. It's great for things like restaurants, retail establishments, things like that. They're winners and losers, okay? The thing to be careful about is when we have a drop in oil prices so severe, the cascading effects that can tend to be negative, like an entire country's economy rolling over, can end up being more negative at the end of the day than the positives. In addition, if this is a sign, if the lowering oil prices are a sign that we're seeing weakness in economies around the world, and my prior video casts have said that that is the case, then we could be on our way to a global slump economically, and of course that's not good for anybody. Okay, so let's move on to some Q&A. Let's just start at the top here. How do you determine when the trend is your friend? Yeah, you know, that is, again, anything to do with technical analysis is more art than science. As I've said before, there are no technicians, there are no traders among the world's 20 or so richest people. The 20 or so richest people are all investors like Warren Buffett, long-term investors, or corporate CEOs who in a sense are long-term investors because they're building a company, and companies aren't built overnight. They take years to build. So if you look at, you know, like Sergey Brin at Google, Google was created over the course of decades, okay? Those are the sorts of things that create long-term wealth. So to get back to your question, how do you know when the trend is your friend? Well, the way I start looking at it is from a fundamental basis. So if I feel like the fundamental trend is strong and the stock starts to move in the direction of that strength in a way that breaks out of a channel, and you've seen, if you just look at the today's alert on Dorman products, you'll see that there was a nice, I don't know which way it looks for you folks, but there was a nice short-term channel going up for quite some time that the stock has broken under. For me, with the fundamentals at Dorman looking suspect and the chart having broken through that short-term channel, those two things combine to make me feel more comfortable about getting involved right now. I feel like the trend is negative on a stock whose fundamentals I believe are negative, and therefore I believe the trend is my friend. Not a perfect science, but it's certainly helpful. Okay? We've got somebody here who does not like Applebee's. We'll skip that question. There we go. But you're entitled to your opinion. Here we go. Since I am new at shorting stock, the question is, take Dorm as an example. When selling short, the higher the purchase price, the better. Yes, present ask price is $49.18. What dollar amount would you put in for your short sell price when using a limit? I don't really worry about such a thing, really. When I believe that a stock is fundamentally overvalued or undervalued, I want to get in immediately. I don't worry too much about risk-reward charts on the initial position because I've already determined that the stock is worth more or less significantly than the market is currently assigning it. So if I look at a Dorman products and I think that the potential is for the stock to fall into the 20s, what do I care if I'm shorting it at 49 or 50 or 48? Doesn't matter. I want to get in because if I'm right and I'm proven right tomorrow by some fluke of chance, like the yellow alert, immediately proven right on the risks being at a heightened level and stocks at a heightened level, and you get immediately start to get paid on that, why do you want to mess around with that, right? If the stock is if I'm right and the stock's going into the 20s, I want to short it now, and I'll from that point monitor where the stock goes from there. And if I have to short a little bit more at 52 or 55, who cares? If I think it's worth 27, I actually hope it goes higher. Okay, as long as the story remains the same, as long as nothing changes in the thesis, as long as nothing I see changes my mind about the stock being worth in the 20s, I'm happy to get more at another price, but I'm getting in now. Okay. Next question on probably on a similar track looks like, is there risk that the negative trend will overwhelm fundamental strengths of glue, QAD, Jack, etc.? No, quite simply. Really, you know, the companies are the companies and the stocks are the stocks. Okay, unless these companies are in need of cash that they cannot get any other way except for selling stock, the price of their stock doesn't really have too much bearing on the company. And by the way, I don't want to own stock in a company whose fundamental strength and health is going to be impacted by the value or the price of its stock, right? It's not a very strong company if its stock price is going to be strong enough to bring it down. So in my mind and in the mind of Peter Lynch, Warren Buffett, etc., the lower the price on a stock that you like, the better. Quite frankly, if you own a healthy company, if you've picked a good stock, the lower the price of that stock gets, the happier you should be because it gives you the option to buy more. You don't have to buy more. You might not buy more. You're certainly not going to be happy that the price has dropped. But the fact of the matter is, when you do an analysis of what a stock is worth, think about it like a house. If you buy a house for $200,000 and you get into that house and move in and you say, oh my God, this is the best house. I've never had a home like this before. It's the best money I ever spent. And a year later, the real estate agent calls you up and says, hey, would you like to sell your house? And you're like, no way, I'm never selling my house. Well, you know, the market value is $190,000. You know, you'll never get a better time to sell. And you hang up the phone. You say, geez, I paid $200,000. Now it's only worth $190,000. Is that really going to upset you? No, you love your house. I love my stocks. We do our analysis. We figure out what they're worth. We do a DCF analysis, the gold standard for what a stock is worth, and determine what it should be trading at. So for somebody like a Glue Mobile, the stock should be $7, $8, or $9 a share now, today. That is what the DCF analysis tells us, okay? And before long, if everything goes well, the market will respond by agreeing with us. That might happen as soon as, let's say, February, when they report Q4 numbers, which I expect to be good, and simultaneously, Yahoo Finance will change the estimates because 2014 will be over. Right now it says 2014, 25 cents, 2015, 25 cents, something like that. It doesn't look very attractive. You look at that and you say, oh, no growth company with 25 cents of earnings, maybe that stock's only worth $2.50. And that's what some people are saying. But pretty soon the 2014 number is going to roll off and the 2016 number is going to roll on, and you're going to see 2015 at like 25 cents, and you're going to see 2016 at like 38 cents. Now all of a sudden you're dealing with a company who's going to grow earnings 60% to 38 cents the following year. And if people apply a 30 multiple on that 60% growth, which is a PEG ratio of 0.5, Jim Cramer says use a PEG ratio of 1, right? But if we even use a P ratio of 30 on that 30-something cents of earnings, you have a $10 stock. So we go from a stock that people can justify a $2.50 stock price to a stock that you can justify a $10 stock price on the basis of Yahoo Finance. But guess what? The DCF analysis won't change a bit. It currently says that the stock is worth $7, $8, or $9 a share, and a few months from now, it will also say the stock is worth $7, $8, or $9 a share, maybe plus a little bit, $7.20, or $8.20, or $9.20 a share. It doesn't change. Okay? The value of a company is the value of a company, and the stock price is just your ability, your option to buy more or less at a cheaper price. Nothing but that. If you keep that in mind, that's how you can get rich, like a Warren Buffett, who only views lower prices as an opportunity to buy more in his long-term quest to make money, which only makes sense, right? Because stocks go like this, up and down and up and down and up and down. So if you bought stocks every time they go down, as long as you're buying the right companies, they're eventually going to go up, and you're going to catch the biggest uptrend by buying them when they're down. Buy low, sell high. It's quite simple, okay? Next, what happens in a red alert, and what key factors cause you to declare this is a red alert? Well, we discussed a little bit of that already, but what happens is not something that I discussed. So, you know, if we start to see the dominoes fall, if we start to see some defaults, we're certainly going to see some, I think, bankruptcies and defaults in the oil sector. The back-end shale companies, some of those, you're going to have problems there, and it's going to cascade to the banks that lent the money. How much? Who knows? The world is just an interconnected machine of millions of moving parts, and that's why nobody can predict which way the market's going to move next with any precision. If anybody could, they'd be the richest person on earth, right? So, however, what we can do is look at the trend being our friend, and if the trend becomes such that the falling dominoes cause more falling dominoes and no intervention seems to stop the cascading effect of dominoes falling, that's when we'll know that we're in another red alert situation. I've only issued 2 of those in my entire life, One just before 2000 in late 1999, and one in mid 2007 before the Halloween peak in October of 2007. In both cases, I viewed the situation as untenable, and that there was nothing that anybody was going to be able to do to stop something really nasty from happening. No idea at the time how nasty it was going to get in either case. In both cases, it was much worse than I even expected, right? But that's where the art and science come in. You can't figure out what all the moving parts are going to do exactly. You just know they're moving in the wrong direction. So if we do get to that point, we're pretty much going to want to sell everything, right? Now, will we? Look, personally, I won't sell my stocks. My favorite stocks are already cheap. If they only get cheaper, I don't see a situation where, if you look at like a Glue Mobile, if we end up in a recessionary environment around the globe, people are going to stay in instead of going out, instead of going to the movies and spending 20 or 30 bucks, they might stay in and play a Glue Mobile game for $5. This is the sort of thing that we've seen in past recessions. It's called nesting. Okay, there are certain nesting activities that actually benefit in downturns. So we're going to look at each of the stocks one by one and determine what to do with them. We might downgrade them a little bit and say take a little off the table. But one thing we'll definitely do is increase our hedges, and it's not going to be a hedge anymore. Okay, so right now, if you've watched the other videos, and I actually hope you do and read the methodology to find out how much of a hedge you want to put in place to protect your current long positions, right? But it goes from protection to offense. All right, that's the key answer to your question, is that we're going to move from just being protective to being offensive. So right now we've got roughly a situation where we roughly have 33% of our money invested in stocks, 33% of our money invested in hedges, and 33% of our money in cash, right? And that cash gives us the flexibility of what we do next. If there's a red alert, I'll tell you the very first thing that's going to happen is that 100% of that cash, that 33% cash position, will go into the short bucket. And so immediately we're going to be short twice as much as we are long. And so if the market does go down from there, we should benefit from that. And that worked very well in 2000 and 2008. Let's see, 2000, 2001, and 2008. All three of those years, I was up 35 to 40%, while the markets were down about that same amount, because I was treating all of my investments in the opposite manner as everybody else. Okay, that's how you make money in down markets, and that's how you make a big impact on your life. If we can do a little bit of math here. The average person loses 40% in a downturn for 2 years in a row. $100,000 becomes $60,000 in year one, and that becomes $36,000 in year two on another 40% decline, as what happened in 2000 and 2001. Now, instead, if you flip the script and become short and take advantage of those declines, your $100,000 in year one earns 40% instead of losing 40%, and you go to 140,000. In the following year, it earns another 40%, which is 196,000. Okay, so the difference between being long in a red alert market versus short in a red alert market is coming out with, if you can see that, your 100,000 becoming 36,000, or your 100,000 becoming 190,000. It's a six-fold difference. And if you're dealing with $1 million or $5 million, think about the difference it is there. It's huge. Okay, you come out of this six times more valuable than everybody else. You're ahead of the game. Hope that helps. Keep going here. I think this is a similar question to before. It appears that putting in a sell short with a limit of $50 would have people jump on it, considering the closes at 49.18. No. No, you're trying to sell the stock. You're not trying to buy the stock. You're trying to sell the stock first and buy it later. That's what selling short is. Effectively, you are borrowing the shares from somebody else and then selling them, and that's why you're short. You are short the shares. You don't have the shares, right? If you go to the store and you buy $20 worth of stuff and you only have $10 in your pocket, you're $10 short, right? You borrow the $10 from somebody else to pay things off, right? So you have to think about shorting as the exact opposite in every regard as buying, right? You're selling first and buying later. When you're buying a stock, you buy it at $5 and you hope that it goes to 10 so you can double your money. In shorting, you sell it at $10 first, hoping that it goes down so that you can then buy it and make money on the difference. Each case, you make $5 a share. Okay, so hopefully that helps. So yeah, if you're looking to put a limit order in, you want to put it at, well, if you put a limit order at 50, it has to rise to 50 before somebody will jump on it. Okay, Frankly, I would be moving on this personally. I'm short the position now. I like it at this price. I'm not going to play games. I'm in. Come what may. Next. How do you feel about using options in an IRA as opposed to shorting a stock in a trading account? I wasn't aware you could buy options in an IRA, but if that is possible, it's a matter of preference. That's more of the art and science, right? As long as you're right. The big thing here is making sure that you're right about the analysis. We have to make sure that our DCF analysis is accurate, and the way we do that is to research the pick thoroughly. We probably have put, just an estimate, 300 hours of work into dormant products. We have at least 5 people in-house that have worked on this project, along with a number of outside consultants, and so we feel good about that analysis. So from there, how we play it is less important than making sure that we play it. Okay. Now, as for options, I'm not a big fan of buying options, and there's one very simple reason for that, and that is options expire. They have an expiration date. So let's say that I'm right about dormant. Let's say that I'm really right about dormant. Let's say that dormant products is going to implode and go to $5 a share. Okay. My last short broad vision went from 45 to 6 roughly. Okay. If we have that situation, the problem with options is if you buy a January put to try to take advantage of the move, and dormant goes to $60 before falling to 5, you might lose 100% of your money on your options. While somebody who's short the stock and just patient about waiting for the market to find the true value of the stock, you're going to pay off, because your short position in general, it won't have an expiration. It can be called back on you. There's an it's not common that it happens, but most of the time you can hold your short position indefinitely, and that's a much more beneficial situation for me than using options. There are many people who use options well. It's not my expertise. You'll have to consult with somebody like that. I prefer to just play the stocks straight up. Okay. Dorm is a short because there is weakening demand for used car parts due to strong demand for new cars. But if you're bearish on the U.S. economy and the stock market, doesn't that mean people hold off on new car purchase? Bullish for Dorm. Jay, there are many moving parts here. Okay. So first of all, let me make it clear. I am not bearish on the U.S. economy. I'm bearish on the global economy, minus the U.S. If you've seen my past video casts, it's almost like a broken record at this point. The U.S. has been stealing growth from the rest of the world, primarily China, by bringing manufacturing back to the U.S., and primarily from Russia by fostering growth of the oil production that's happened here in the U.S. So we've taken a lot of oil market share. We've taken a lot of manufacturing market share. That's not good for those other markets. And what happened as a result is the U.S. market's gotten stronger. And as a result, one of the hedges I talked about, the U.S. dollar, UUP, has gone up significantly. And when the U.S. dollar goes up significantly, it hurts a lot of things. It hurts U.S. multinationals to some extent, yes, but that's offset by fallen oil prices. But there are also emerging markets where those countries have taken on loans denominated in U.S. dollars. But the U.S. dollar has gone up so much that now the amount that they owe in their local currency is increased. So they're in greater debt because the U.S. dollar has risen. There's all kinds of after effects of strength in the U.S. So be clear about that, first of all. Now, as it pertains to Dorm, my take on the situation is that dormant products has benefited from a low interest rate environment. They have benefited from an increasing number of used cars out in the market, and those are two of the big things that have occurred. And they've also benefited from some terms and conditions that they've given to their customers that have been increasingly favorable. In my opinion, those things have all played out to an extent that they have diminishing benefit for Dorm. So even if we went into a recession and it made people hold off on buying new cars, it's going to be the same situation. Dorms already benefited from that just about as much as they possibly can. So if something like that returns to the equation, I think it's more likely that a U.S. recession would cause dorm stock price to greatly fall. It is a part of the Russell 2000, and so as the Russell fell, it would fall. And I don't think they would get any more benefit from the slackened new car demand than they already got in the past. So it's all a matter, it's a second derivative issue, right? In order for them to continue having more benefit, to continue to have more momentum, they have to have more logs in the fire. And that's why you've seen the amount of receivables they've factored have been increasing every year. They have to throw more logs in the fire. And frankly, I think they're all out of trees. Okay, that's the thesis here. So I think if the market goes down, it's good for our short on dorm. If the market goes up, it's probably because the U.S. economy is doing well, and that's not so good for dorm. Dorm could trickle up a little bit with the market. Could dorm and stock go up 5% next year if the market goes up 10%? Sure. But if the market goes up 10%, our longs will probably go up 20 or 30%, and dorm on the short side as a protection against that, losing 5% is a very small price to pay to have protection in an environment where we've got this high risk. Okay? So it's all about playing the risk reward appropriately. Why do brokerage houses make it more difficult to short stocks? Some put a $50,000 price tag to short. That's the discretion of the brokerage firm. So I personally have multiple brokerage firms. I deal with E-Trade, Ameritrade, and UBS, among others. And that's because different ones have different strengths and weaknesses. Some charge you less. Some will give you more accommodation in terms of how you short. Some will give you research, different things like that. It's always good to have multiple brokers set up once you get to a level of assets that you can spread those assets across different brokerage firms to play one off of each other. Certainly when I first became, had enough money to add a second brokerage firm, at very least what ended up happening was I put half of my money into E-Trade after calling them and saying, look, I've got my money with Ameritrade. What will you give me if I switch to you guys? And you'd be surprised. They came back and they said, hey, we'll take a couple dollars off of your trades. We'll give you 50 free trades. They offered more than what their promotions talked about. And then, so when I moved my money over to E-Trade, Ameritrade came back and said, hey, why'd you, move all that money over? And, what ended up happening is over the next few years, I just play them back and forth off of each other. E-Trade would offer something, and I'd switch my money there. Ameritrade would offer money, something there. So you get an initial benefit there in addition to the flexibility, right? Something to consider. Is Russia moving into a full-blown recession major enough for a red alert? If that was the case, we'd already be at red alert. Russia is going to be in a recession if it's not already. I expect it to be a severe recession, enough to make our puppy dog go bonkers. It's going to be rough there. But Russia's not, Russia's not everything, right? They're Archer. Sorry about that, folks. Hopefully he'll calm down in a sec. Russia's already going to a recession. It's going to have domino effects on other things, and that's okay for now. Okay, it's just something that we're monitoring. It's something to keep in mind. Pay attention to what you're seeing out there, though, right? And see if the effects that the accommodation, we saw Russia raise interest rates to 17% last night. We saw the Fed come in with more cautious accommodation today in their language, and all that's positive. Let's see if those positive effects hold. Okay, the positive effects was primarily in the stock market, not in the currency and bond market, so it's a little suspect. Okay, the risks may have fallen a little bit, but only a little bit. All right, but as far as the red alert, it's far too soon for that. And by the way, I'm not going to give you much of a warning on that. Okay, everybody's going to get the red alert at the same time if the red alert comes to pass. Okay, can I explain how I plan my entry points and exit points in a trade? One thing I struggle with. Okay, so first of all, the methodology is where you want to go. Read that a few times. Okay. One thing you'll see is one of the rules is when you find a position that you like, if you find a stock like Dorman at 50 bucks that you think should be in the 20s, jump on it. Don't wait. Okay. Maybe you go in with a half-sized position and fill out the rest of the position if the stock moves against you initially. But look, if I tell you that I'm selling $20 bills for 10 bucks, you want to buy some right away. If all you have in your pocket's 10 bucks, you're going to buy a $20 bill and then run to the ATM for more. Okay. So that's how I do with my entry points. I don't worry about timing entry points. Remember, there are no market timers among the top 20 richest people on the planet. There are no market timers among the richest people on the planet. One more time. There are no market timers among the richest people on the planet. Technical analysis does not make you rich. You have to be one of 100 people to get rich on technical analysis. And if you're one of them, congratulations. You don't need to hear my answers to these questions. But if you're not one of those people, I'm certainly not. The best way to make money is to be buying $10 bills, $20 bills for 10 bucks. So that's how you get in. When do you get out? When the risk becomes too high relative to the potential reward, right? You don't want to get greedy. When we had a Global Star, perfect example, right? We picked that stock at 67 cents because we felt that the potential was for the stock to rise to 4, 5, or 6 bucks, right? Although there was also a chance for the stock to go to zero. But when you have an opportunity, let's say a coin flip opportunity to either have your money go to zero or your money go to 4 bucks, that coin flip is worth $2. But the stock was only worth 67 cents. So we were risking 67 cents for something that could go up to 4, 5, or 6 bucks. Now, when the stock did get to $2, that equilibrium point between 0 and 4, we weren't excited anymore. Okay, great. So if things work out, the stock goes to 4. But if things don't work out, the stock goes to 0. I can either make 2 bucks or lose 2 bucks. I don't want to do that. If I want to make 2 bucks or lose 2 bucks, I'll go to the casino. Okay, so that's what you monitor, and the risk-reward charts help with that, and the methodology helps you to learn more about risk-reward charts. So I highly encourage you to do that and pay attention to more of the videos that we've done on risk-reward charts, and just monitor things that way. In addition, obviously, when the time comes to get out of a position, that's what we're here to help you with. But certainly, I suspect that your question came for any other picks that you might have out there. Just be careful about the risk and the reward. Think about how much you stand to make versus how much you stand to lose if things go wrong. Okay, and be very, very picky. All right, there are 20,000 stocks out there. I only like to pick 5 to 10 out of those at any given time. The pickier you are, the stronger your team's going to be. Okay. Let's see. Delete that. We have a few comments about the pick getting out there into the public domain. Look, you can't keep picks from getting out into the public domain. And by the way, it wasn't a complaint; it's more of a statement. But I'll make a statement to that. The important thing here is, so there are people out there that maybe know that Mark Ohms said that Dorman Products is poised to plummet. They don't know why. They don't have the thesis, and therefore they don't have the confidence. They don't have the methodology. They don't have the data points that we have. They don't have the data points that we're going to share in the months ahead, and they don't have the updates that we're going to provide as things unfold. Okay, so envision a scenario where Dorman Products makes their Q4 numbers. Wouldn't surprise me a bit, and wouldn't bother me a bit. It doesn't change anything. It just means they made their numbers. Okay, it doesn't change anything. Companies make and miss their numbers on the way up and down. It happens. So let's say that happens. Okay, anybody who's not within the PTT fold, who doesn't understand the methodology, who doesn't understand that them making their Q4 numbers doesn't change the thesis that the stock should be at 20-something dollars a share will give up. They'll cover their short position. They'll say, that Mark Gomes stinks. What a terrible pick. Thanks a lot for nothing. No, thanks a lot for nothing for you for not being a subscriber and getting the information you need to understand whether or not how the pick is doing to get your updates. And by the way, not for nothing, but I'm not right every time. I'm wrong 30% of the time, right? And one thing that we do here is make sure that we get you folks out of the bad picks before they get really bad. So what happens with like Adelia, right? One of our 30% of the picks that go wrong, and somewhere around, what was it, 79 cents, we said, you know what? The winter was too strong, it was negative. Alibaba's coming to town, and as a result, Google and Amazon are becoming more aggressive on the e-commerce front. Smartphones are proliferating faster than ever because of the cheap Android phones, and as a result, everybody's shopping online. This is bad for retailers, and Delia is a four-wall retailer. We were wrong. Let's get out of here before things get worse. What happens next? Stock goes bankrupt eventually, okay? If you're a PTT subscriber and you got that notification that we put out, you got out of the stock, took your lumps at 79 cents, and you said, thank you very much, what have you. That's the price of chasing triples, is to lose 30% once in a while. You got out. But what about the people who didn't get that alert, okay? They might have jumped in because the Twitter sphere, goes crazy when Mark Gomes makes a pick. And so they jump in, but they don't know when to jump out. They don't have the information, okay? So let's leave it at that. Pay attention to what we're doing. We're here to give you updates on our picks. We'll continue to do that. We'll continue to research our picks. And in fact, if we run low on questions here tonight, I'll give you some updates on our current picks, because we've gotten new updates on, I believe, every single one of them. So we'll share a little bit of that. Next, what do you think about shorting the oil ETF? If the U.S. is taking business away from global markets, will the S&P drop be relatively modest, even the rest of the world drops more deeply? Okay, so for the first part of that, I have no idea. I'm not an oil analyst. I never have been. In fact, if somebody asked me what some of my weakest areas of coverage would be in terms of knowledge, it's certainly energy and biotech. I'm smart enough to use common sense and see that the low interest rate environment has been positive for enabling back in shale and whatever the other areas where we have fracking. And so the cheap money has enabled us to do more oil production here in the U.S. And that's a simple supply and demand thing, right? In the absence of strong global growth, a commodity that's seeing greatly increased production is going to eventually see a greatly decreased price. I believe that we didn't see that happen in oil initially because of speculators, but who knows? I don't know. If I knew, then I probably would have been able to jump in and take advantage of that 50% decline in oil prices. So forget about playing around with things that you don't necessarily know about. Like I said, there are 20,000 stocks out there to play with. Pick the 5 or 10 that you know best, okay? In addition, to short an oil ETF at this level would constitute chasing. And if you've read the methodologies, you know chasing is it's an invitation to hang yourself. I talked about that on the last Yellow Alert video cast when I gave an update and said, hey, look, the stock market's dropping. We're making lots of money. This is great, but don't chase it. If you didn't jump in on the Yellow Alert, we're already down 4 or 5%. Some of these things were down significantly more, okay? Don't chase anything, ever, okay? You don't want to chase things. So to answer the rest of your question, if the U.S. is taking business away from other markets, will the S&P be relatively modest in terms of dropping relative to the rest of the world? Common sense would dictate yes, unless it's already priced in. I've been saying this all along, okay? When we talk about hedging your position, we said that some of the hedges that you could use are you could short the S&P, you can short the Russell, you can buy the U.S. dollar, UUP. You could short the Chinese ETFs. There is VEU, Victor, Edgar, Umbrella. Sorry, military folks, I know that's all wrong. VEU is an ETF that buys everything except US. I'm short that as well, and that was one of the nicer winners, going from 48 to 45 initially, and I've actually been short that for some time, and I'm up very nicely in that position. That's been going down quite nicely. So yes, of course, if the US causes a global contagion by stealing all the market share, then of course everybody else gets hurt. Another example of that, by the way, and this is something to keep in mind. We do have the members forums, and we're really happy to hear from folks when they have ideas, right? Take the example of Uber. For those of you who don't know Uber, U-B-E-R, check it out. It's basically an internet-based transportation service, right? If you want to, I'm going to go to the airport, then I can use Uber to get a car to take me to the airport cheaper than a taxi will. Okay, so as Uber became more popular and still becoming more popular, it's obviously something that the taxi drivers aren't going to like because it's bad for their business. And because of that, anything related to taxis on the stock market, and there is a stock whose ticker symbol is taxi, surprisingly, that's been getting walloped as a result. So keep that in mind. As we see trends, as you see trends out there, we're not going to catch everything, okay? Heck, I've been talking about Russia getting hurt by U.S. oil production for most of the year now, but wasn't smart enough to short a Russian ETF. I don't have all the answers, right? But you can help out with that. Next up, how do we determine when this yellow alert is over? Will I send out an update? Yeah, that's a tricky thing. Yellow alerts, they're not meant to be timed perfectly, nor are they meant to understand when they're over. Okay, it's tough. Generally speaking, a yellow alert will last several weeks to a couple of months. And what you want to try to do is squeeze a few percentage points of profit. I'm sure some of you already did. Right? When you see the market go straight down and into a panic, that's sometimes an opportunity to take some profits off the table. And if you did, good for you. I haven't done it yet. And maybe it'll work, maybe it won't work. If the stock market continues to rise and it seems like oil prices start to stabilize and Russia starts to stabilize, maybe by the time it becomes apparent that the risks have been averted, the stock market might be higher than when the yellow alert was issued. The trick here isn't to try to make a certain amount of money. It's to try to avoid losing a certain amount of money. Okay, being protective with your money is equally important as it is to make money. Okay, and that's the thing we want to make sure of. We're not going to make money on everything. We're going to focus on good risk reward situations. So keep an eye on the situation here, kind of use your judgment. This is where the art supersedes the science a little bit, because I'm not a perfect barometer of how far up or down the market's ever going to go. I'm usually pretty good at picking the risky points, as you've seen with the last few yellow alerts. We got 5% out of the November alert. We got 10% out of the July alert. So maybe you can use that as your guide. Certainly getting 4% out of this alert in the first 6 days may have been a sign that we were due for a little bit of a bounce. Certainly when things like that happen, keep in mind, right, with Russia going straight down, with the stock market going down for, 5 or 6 days straight, you had to think that the Russian government was going to step in and try to do something to calm the markets, and Janet Yellen would come in and try to do something to calm the market, and sure enough, they did. Okay, and that's why you don't chase. Right? Because when things start to get really steep, somebody steps in and takes some action. Question from Calvin Banks. He didn't miss anything, so your question is relevant here. What does AeroGrow need to do to accomplish to earn an upgrade? And will 7% GDP growth projection in China fit into my short China thesis? Okay, so starting with AeroGrow, with any company, basically just go to the methodology and see the definition of each category, right? Right now, AeroGrow is speculative because it has a lot of risks. There is a lot of potential reward, but they haven't really, they're executing well. They're growing their revenue by 50+% on a quarterly basis. I expect that to accelerate this quarter. I think they're going to have a much stronger revenue quarter than they've had in a long time. But that doesn't get them out of the woods. They're not profitable. That's still not proof that the American public or the world public has really latched onto this product. Okay, if that happens, if people latch onto AeroGrow's product, this stock could go to 20, 30, 40 bucks a share. You see what happened to SodaStream. You saw the market cap of that company. There's no reason why that can't happen eventually, especially with marijuana legalization. Marijuana, if you look at what you grow in an AeroGrow now, for me, it's basil, right? Basil's not as inconvenient a product as soda, right? So for SodaStream, it's easier, and for a Keurig, it's even better, right? Because everybody loves coffee. So to have coffee at your disposal is worthwhile. Have a coffee maker in your house. To have soda at your disposal, not as attractive as coffee, but still attractive. Basil, do you really need it at your disposal in your house? Some people do, some people don't. I like it myself. I don't expect that most people do at this point, but as marijuana legalization comes up, now you're talking about a product that there are going to be a lot of folks that will want it at their disposal, number one. Number two, more importantly, they're not going to want to pay for it, especially if you look in Colorado, it's like 38% taxes. It's an expensive product. If you grow it at home, it's free. And AeroGrow will enable that at some point if it becomes politically correct and federally legal to do so. Talk about opportunity, right? Now, of course, the risks are that it never catches on, and they continue to burn money, and it eventually could go bankrupt. The stock could go to zero. Okay, so we're taking the chance on a $4 or $5 stock that could go to 30, 40, 50 for a few dollars that could go down, and we're going to monitor the situation so that if we determine that things aren't going right and moving against us, we get out before we lose all of our money. But if it happens, just make sure that our position is small enough that it doesn't hurt. And that's why it's a momentum pick, small pit, right? We have to monitor the risk and reward of that stock, particularly the risk. The risk is most important. You don't want to lose a ton of money on any stock. That's one of the most important things. Making money is easy. Not losing money is what's hard. And we do that by position sizing appropriately. So there are a lot of things that go into it. Again, the methodology definitions will give you some handle on that. And frankly, it's not important what the exact classification of the stock is, because somewhere between here and moving up to, let's say, a momentum stock, it will warrant not a 1% position, but a 3% position, 5% position, every step along the way. So you can use your judgment there. Our guidelines will help you a little bit if you decide, you're really bullish on Arrow and you want to make it a 2% position. I'm not going to fault you for that, right? It's just you want to stay within some reasonable bounds to protect yourself against a big loss, because that's what can be debilitating, as you saw with that math I provided here earlier. Okay. As far as 7% GDP in China, I don't think we're going to see it. Frankly, China's been in a real estate bubble. They've been in an infrastructure bubble. A large percentage of their GDP has been funded by the government, building infrastructure well in advance of the need. In other words, they're borrowing growth for the future. At some point, you can't borrow from the future any longer, and that's why we get the 2000 crash. It's why we get the real estate crash, right? Everybody was borrowing from the future, lending money, at low interest rates and bidding up these properties, and that brought up the speculators, and the speculators bought up the properties, and that caused the real estate bubble, and eventually reach a point where there's not enough new people coming in to make the purchases to keep the prices going higher, and then the whole thing falls apart. Same thing can happen in an economy that is being artificially inflated. Same thing can happen in an industry like oil. Okay, I think GDP growth in China is going to be at very least in the 6s next year. I don't have exact calculations on that stuff, but 7's the number. I don't think it's going to be 7. I think they're running out of logs to throw in that fire. You can't, keep knocking down trees from the future for the present, because then you're not going to have any forests later on. Regarding Glue Mobile, what do you think about the decreasing of profitability they plan for Q4? Yeah, so, okay. Decreasing profitability for Q4 is simply because one game, Kim Kardashian, did so well in Q3. Who cares? I don't care about quarters. Okay? Think about this. I've been earning close to 40% a year since 1996. The way that has been done, and by the way, I lost money almost every year before 1996. Before I was taught by my mentors, it's not my genius. Okay, it was lessons from smart people. John Cassarini at JAC Capital, following lessons from Peter Lynch. I remember in my first job listening to cassette tapes of Peter Lynch and saying, geez, how do I stop being such a loser? And then Warren Buffett, of course, came on the scene, and I started following his lessons as well as the lessons of the person who taught him. Okay? And one lesson that comes clear from all of them is, who cares about this quarter? And who cares about this game? Nobody's going to remember Kim Kardashian video game 20 years from now, but Glue Mobile might still be around, and it might be huge because of all the other games that they're going to create along the way. Nobody knew Kim K was coming along a year ago. When we picked this stock, everybody was complaining about how Deer Hunter was going to fall off. And now people are complaining about how Kim Kardashian is going to fall off. And yet the company is 100% larger than it was then. If we exclude the acquisitions that they've made, it's still 80% larger than it was when we picked the stock. And yet the stock is pretty close to the same price as when we picked it, maybe 20% higher. 20% is a nice gain, but it's nothing compared to the 80% growth that they've had. Why has that happened? Because individual investors out there don't think like Warren Buffett, don't think like Peter Lynch, don't think like John Cassarini. They don't have that long-term view. They just want to live for the moment. And living for the moment isn't going to make you rich. Simply not. Doing what everybody else is not doing is what will make you rich. If you do what everybody else does, you're going to get the same result as everybody else, right? So if everybody else is not rich, then the common sense move is to not do what they do. So to answer your question, I'm not worried about Q4. It's very natural for a game as big as Kim Kardashian to downslope eventually. I expect that the guidance that they provided was prudent relative to what they see in their pipeline, and I expect that they will do what they have done for every quarter since 2008. Look at Yahoo Finance if you don't believe me. They have made or beaten every quarter since 2008. You've seen the stock come down dramatically in the last 2 quarters. Look at Yahoo Finance. They killed last quarter. They beat the numbers by 6 cents. People didn't like the guidance. They want to complain about something. People will use any excuse, confirmation bias, any excuse to do what they want to do. And that's why the methodology is so important. The methodology tells me what to do. What do I want to do? I want to do all kinds of crazy things. The things I want to do will make me lose money, like it did back before 1996, right? And then I had to say to myself, do I want to do what I want to do, or do I want to make money? So I wrote up the rules, and I follow the rules despite what I actually want to do. And then if I want to do what I actually want to do, I go to the casino and have a little fun there. Or when I talk about the art and science about which ETFs you choose to play as a hedge, that's when I get some choice. A little bit of fun there, okay? All right, let's see. Let's start to wrap things up. Sorry for being so verbose as usual with some of these questions and answers. Hopefully it's helpful. I think we're done with that one. All right, I think we've got most of it here. So just in the last few minutes that we have, let's wrap up with a few things. I've already talked about Glue, and our indicators suggest that they are going to beat the numbers that they have provided. And even if the indicators were giving us a murky picture, I'm going to give you a word of advice. Trust the management team. Okay? Always trust the management team in a company that you own stock in. They were given the job for a reason. If you are a better CEO than the person in place there, then you should go get that job, right? The CEO of Glue is great. I know a lot of people don't like him. They think that he's snaky, that he looks, a little slimy on TV or what have you. Who cares? The man has beaten every quarter since he's been there. I don't care what he looks like. I don't care how he comes across. All I know is what he's doing. So my impression of him, whether or not I like him, is irrelevant to the situation. All that matters is how he executes, and he executes phenomenally. So until he proves for, let's say, 2 or 3 quarters in a row that he can't do that anymore, trust him. I know it's hard for a human being to do something like trust, but you have to. And there's one simple reason why. Because it's in his best interest for that company to do well. And he was hired by people who also want that company to do well. Everybody that was involved in his ascension to CEO want that company to do well, including himself. If you go against that, you're going against all the smart people who were involved in putting him in place. And you're going against all the education that he put in to earn that role as CEO. That makes no sense whatsoever. Trust the company. I think Glue's going to beat their numbers. If they don't, it's no big deal. I'm sure there'll be a good reason for it. But until he proves otherwise for 2 or 3 quarters in a row, I like what I see there. Okay, so that's them. QAD, they recently had some one-on-ones this week with investors. The stock popped in reaction to that. It looks like everything's going well there. Automotive, especially U.S. automotive, is 35% of their business, and that's going very well. In addition, no matter what, this company is still a value. They have a huge base of maintenance revenue, and if they were bought out tomorrow, if I was the one in charge of deciding how much to pay in a buyout situation tomorrow, I would pay at least 33% more than the stock is going for today, and I would make a lot of money on that acquisition. Okay, so their business is going well. The U.S. dollar going up is not great for their international business. There's always pros and cons, of course, right? But the bottom line is the value is still there. The company, no matter what, to me is worth at least 33% more than what it's going for, so that's nice. Jack's Pacific, let's move on to that one. Man, I mean, what really cracks me up is that we've got people out there who are complaining about the sellouts, okay? When a company sells out of a product, I'll give you a little hint, it's almost always bullish, okay? The one exception, is if the reason that they're sold out is because something broke in their manufacturing chain, okay? And I can tell you that nothing's broken in their manufacturing chain. In fact, they've been ramping up manufacturing. They're selling as much as they can. I'll tell you this right now. This is a management team that's been in place for a long time. I don't particularly like the way that the CFO communicates with Wall Street. He has to get better at that. But he's still, at its core, he's a solid CFO. The CEO is fantastic. This guy has tons of experience. He's done it before. When he has the products to sell, when he has the opportunity, he takes advantage of that opportunity. And he's been given a heck of an opportunity, and he's taken advantage of it. So listen to me right now, all right? There is nobody. I don't think there's any company or any CEO that could have anticipated how much demand they were going to see for these products, particularly the Snow Globe Elsa. And it would be imprudent. It would have been horribly imprudent of him to ramp up manufacturing to meet the demand that we see right now, because nobody could have forecasted it. And if it didn't develop and he put all of those pieces in place to manufacture all that product and it didn't come to pass, they would have lost money instead of making a ton, which I believe they're doing right now. Okay, so again, this comes back to what I said about Glue. Trust the management team. You can be frustrated that they haven't been meeting demand as much as humanly possible, but guess what? There's always something to complain about. You are always going to have something to complain about. I do too. It's human nature. We're always going to have something to complain about. Cut it. Trust the management team. That's what the methodology is for, okay? These are emotions. Trust, fear, euphoria. If you have an emotion, the chances are your emotion is wrong. It will be right from time to time. You have a good gut feel about this or that or the other thing. But in general, you don't want to count on that. It's not reliable. What's reliable are DCF analyses, the teachings of Warren Buffett, multi-billionaire, not a bad person to listen to, okay? Trust the management team there. So QAD, Blue, Jack, AeroGrow we've already talked about. I think they're going to have a phenomenal holiday season. All indications are there for that. We don't know where they're going to go next. It remains speculative. I'm not going to change it from that until we see signs that they're gaining real traction with the consumers buying up this product and the stores restocking them. But for now, we've got some nice momentum there. And of course, that leaves our final pick, Mattersight. And everything that I've heard from our contacts, we put a lot of money into this. I mean, a lot of money into researching the stock and staying on top of what's going on there. And my belief is that they're seeing accelerating demand for the product, which is great. I mean, they hit an inflection point. They figured out how to sell it. They figured out how to make it work just right. They've got a few other things left to figure out. Of course, there's always something to complain about. If there wasn't, they wouldn't need a management team, right? But most of that is all out of the way, and things are going great. I think we're going to see them hire more executives in the sales and marketing ranks. Certainly, they should start hiring more salespeople. I love this idea right now. I don't think there are many people that understand what the value of this thing could be if they continue to execute the way they are. There's a reason why it's called a momentum pick, because the company does now have momentum, and we'll see what happens. If they put together a few more good quarters, we might have to upgrade that up to a core pick. It certainly seems to move in that direction, and we'll see what happens. I think that's it. All right, we ran a little bit over. Hopefully you don't mind. Get that update on all the rest of our picks. Keep making money. Stay safe, right? It's a risky environment out there. Don't worry about making money. The market isn't up very much this year. If you've been hedged, if you made no money this year, it's not a big deal, okay? If you followed all the rules of the methodology, you got out of Pixelworks at $9 a share, you got out of Blue Mobile somewhere at $7 a share, you put your hedges in place on our last 3 yellow alerts, if you executed against all of that, you've done very well this year. I myself have not done the best job of executing against the methodology. Of course, there's always the psychological aspect, right? I know what the rules are. I didn't get out of as much glue as I could have at $7.50 a share. I put a hedge in place instead, right? Things like that, and I'm still up 20%. Okay, so it's not hard to have a good year if you follow the rules of the methodology, even when the stock market isn't making it easy. The key is to stay safe. Don't try so hard. Okay, this is not a day-to-day game. If you get worried about how much money you make on a day-to-day basis, you will lose. Okay, that characterizes exactly how I was in the early and mid-90s until those mentors got a hold of me and said, hey, cut it out. Don't worry about tomorrow. Don't worry about today. Don't worry about next week. Worry about the valuations of the companies you're involved with. Worry about the stories of the companies that you're involved with on a big picture basis, right? And forget about the minutia, because the big picture is what's going to drive these guys. And be patient, because 90% of a stock's move happens in about 10% of the time. Okay? So what does that mean? It means 90% of the time nothing's happening. And if you're watching things the 90% of the time, you're going to be frustrated. That's the price of getting rich, frustration. Personally, I'm okay with it, right? You make your millions, you can buy things, you can go on vacation, you can alleviate your frustration. And by the way, you can also ignore the market, because at the end of the day, if something happens with one of our picks, you'll hear it from me, okay? So through ups and downs, through thick and thin, PTT Research is here to teach you the lessons that made Warren Buffett a billionaire, Peter Lynch famous. Stick with us. We'll stick with you, teach you more about these lessons, give you more of these yellow alerts, keep you abreast of what's happening so that you can make your millions, keep your millions most importantly, And who knows, one day you might have 1,000 of those big ones, so you can call yourself a billionaire too. Hopefully I get there first. Good luck. Talk to you soon.